Welcome, friend, to Markets and Economics. Today, we work through a complete guide to the various trading and investing styles, providing a solid foundation for our financial journey. If you're confused about scalping, swing trading, long-term investing, or which strategy fits your personality, this video will give you total clarity. We break down every style, the tools you need, common mistakes, examples, and how to choose the perfect strategy for you. There is no single best strategy in the markets. A strategy only works if it matches your risk tolerance, personality, time availability, and capital. The right match turns confusion into confidence and discipline into profits. Let's begin with the fastest styles and move toward long-term wealth building. Scalping is the fastest and most intense trading style. Trades last seconds to minutes. You rely on speed, precision, and tiny profits that add up. Time horizon, seconds to minutes. Activity level, extremely high. Risk level, extremely high. Analysis, level 2 data, time and sales, micro patterns. Capital needed, high plus ultra low brokerage. Tools, level 2 depth of market, order flow, VWAP, fast charts, 1 second, 5 second, 15 second. Personality fit, disciplined, emotionless, extremely fast thinker. Common mistake, overtrading and chasing micro moves when liquidity drops. Real-world example. A scalper enters a stock moving quickly after a new spike, exits seconds later with a 0.1% gain. Risk-reward. Often 1-to-1 or smaller, depends on accuracy. Best for professional traders with top-tier tech and focus. Day traders open and close all positions within the same day. No overnight risk. Time horizon, minutes, hours. Activity, very high. Risk, very high. Analysis, price action, indicators, intraday trends. Capital needed, moderate, high. Tools, VWAP, EMA 92050, RSI, MACD, new scanners. Personality fit, decisive, focused, thrives under pressure. Common mistake, revenge trading after a loss. Real example, buying a stock breaking yesterday's high and selling within 20 minutes. Risk reward, 1-to-2 or 1-to-3 is common. Best for full-time traders. Swing trading is perfect for those who want action, but not constant screen time. Trades last days to weeks. Time horizon, days to weeks. Risk, high. Activity, moderate. Analysis, trend lines, patterns, momentum indicators. Capital needed, medium. Tools, RSI, MACD, fib retracement, supporter resistance, daily charts. Personality fit, patient, rational, and comfortable with minor pullbacks. Common mistake, holding a losing trade during an earnings announcement. Real example, buying a stock after a pullback in an uptrend, targeting the next swing high. Risk reward, 1-to-3 or better. Best for people with full-time jobs. Position traders hold for months to years, riding major market trends. Time horizon, months to years. Risk, moderate. Activity, low. Analysis, macro trends, fundamentals, weekly charts. Capital needed, any reasonable amount. Tools: weekly or monthly charts, moving averages 50, 100, 200, macro reports, personality fit, calm, long-term thinker. Common mistake: entering without understanding long-term fundamentals. Real example: holding banking stocks for 2 years based on rising interest rate cycles. Risk-reward: compounding with large trends. Best for people who can ignore short-term noise. Delivery trading means buying shares into your demat account and holding for weeks to years. Analysis: fundamentals plus technical timing. Risk: moderate. Activity: low. Capital needed: any amount. Common mistake: buying stocks without understanding business quality. Best for beginners and equity investors. Value investing, made famous by Warren Buffett, means buying great companies at a discount. Time horizon: years, decades. Risk: low, moderate. Activity: very low. Capital needed: any. Tools: PE, PBV, ROE, ROCE. Moat analysis: balance sheet study. Personality fit: patient, contrarian, deep thinker. Common mistake: buying low PE stocks with weak business fundamentals. Real example: buying a stable FMCG stock during market panic. Growth investing focuses on companies expected to grow faster than their industry. Time horizon: long term. Risk: high. Activity: low. Tools: revenue growth, market share, innovation pipeline, industry expansion data. Common mistake: chasing hype without checking profitability potential. Real example: investing early in EV or AI companies with rapidly rising sales. Dividend investing creates passive income from stable companies that pay consistent dividends. Risk: low, moderate. Tools: dividend yield, payout ratio, cash flow strength, dividend growth chart. Common mistake: buying high-yield companies that are actually financially weak. Best for retirees and passive income seekers. Most real-world investors combine multiple strategies. Popular hybrid methods: core and satellite. 70 to 80% in long-term value dividend investing. 20 to 30% for swing trading or growth opportunities. Thematic plus technical: buying long-term themes but using charts for precise entries. Common mistake: mixing too many strategies without structure. Ask yourself, how much risk can I tolerate? How much time can I commit weekly? Do I enjoy fast decisions or deep research? Do I want quick income or long-term wealth? Am I patient or impulsive? Your answers reveal your ideal style. Success in the market doesn't come from copying others. It comes from choosing a style that fits you. Start small, stay consistent, and build skill over time. Test strategies with paper trading before risking real money. This video is for educational purposes only. It is not financial advice. Always do your own research before investing or trading. Thank you for watching. If you found this helpful, please like, share, subscribe, and hit the bell icon. Comment below which strategy fits you best. More in-depth videos are coming soon. See you in the next one.